Hi guys, thank you very much for joining. This is Dan Burkut, and today I'm going to show you one of the best day trading strategies that I know, and that is based on classical indicators. There is no fancy AI or anything like that on this strategy. It is a classical strategy that I know about around. I found out about I think 8 years or 9 years back. It has been working for decades because it is based on indicators that have been around for decades. It is not your usual setup of classical indicators. So if you are a medium level trader or even an advanced trader, even for beginners, but it will be harder to understand. But this is suitable more for medium levels or advanced level traders, and it is a strategy that probably 99% of you guys don't know about it. And if you do, I know that you have paid a good pile of cash for it because it's a strategy that really, really works. And yes, I will be offering it to you today. And yeah, let's not waste any more time. Okay, so this strategy has been designed to be traded as uh, a day trader, so a day trading setup, or a swing trading setup. I am going to show you the setup for the day trading today, and I am going to make a swing trading setup on a separate video because if I do all of them in one single video, this video is going to be extremely long, and I know that everybody gets bored very fast on YouTube, and I don't want to do that. I want to keep you focused. All right, so stick around to the end of this video because you are going to walk out of it with a very, very strong strategy that has been worked for many years. And even I used a derivative of this strategy even today on my trades. So yeah, very, very good setup. Let's not waste any more time. First indicator that we are going to use is the relative strength index, the RSI. This is one of the well-known classic indicators. If you don't know what it is, do your own research on YouTube. You are going to find a lot of materials related to the RSI. Okay, we are going to use different settings. I am not interested in the period. I am not interested in the line that the RSI is drawing. So I'm going to select none. Then I'm going to go to levels. And for the oversold, I am going to select 10. And for the overbought, I am going to select 90. All right. And this is what I need from the RSI. The overbought and the oversold levels, which will be 90 and 10. The next indicator that I am going to take and put it on top of the RSI, it's the MACD. If you don't know what the MACD is, once again, do your own research. It's an extremely popular and classical indicator that you'll find a ton of materials about it. The signal that the MACD is giving, I am not interested in it, so I am going to give it a none. And on the main one, I am going to change the colors for my personal preference, and I'm going to make it look thicker to be easier to read. In regards to the parameters, we are not going to make any changes. We are just going to use the classical ones, which are 12, 26, and 9. Okay, now this is the RSI on top. Sorry, this is the MACD on top of the RSI. There is one more indicator and we are good to go, and that is the Bollinger Bands. The Bollinger Bands are going directly on the chart. The only modification that I'm going to make to this one is changing the color, my personal preference, and make it thicker so that it will be easier to read. Now, like I said, I am going to use the 15 minutes chart. I would not advise you to use the M1 or the M5. There are many fake signals on the lower time frames. I would not advise you to trade them. This is suitable starting from the 15 minutes. The 30 minutes is not that good. I never really tried trading it. The 1 hour, 4 hour, and the daily charts are taking you more into the swing trading strategy. It's not going to be a day trader anymore. Sorry. So stick with the 15 minutes chart. I have chosen the gold because it is a very volatile pair, and this is a setup for volatile pairs. Now, the next thing that I am going to do is change the candles and go full zoom in. After I go full zoom, I go 2 clicks out. All right. You click full zoom in and then you zoom out to clicks. The reason why we are doing that is because the graphics of the MACD are changing with the zoom in accordance to the RSI. All right, so full zoom, 2 clicks out. This is our setup. Now, the way that the signals are triggered, it's as follows. We need the MACD to be into the overbought or into the oversold area. So right here, the MACD is into the overbought area. Okay, this candle is telling me that the gold is being overbought. The next thing that we look for, so the first thing that we look for is the MACD going into the oversold or into the overbought. If the MACD is not in this area, we are not interested. We don't have any signals. What we are looking for next is the price to be outside the Bollinger Bands. And this candle is also outside the Bollinger Bands, okay? So this means that we have a qualified signal. After we establish that the price is once again in the overbought and outside the Bollinger Bands, we will wait for the next candle that will close and take the price back into the Bollinger Bands. And that happens on the very next candle, which is this one right here. So it spikes outside, but it actually closes inside and it takes the price right back into the Bollinger Band. My entry is going to be at the opening of the next candle, which is right here. Okay, so as soon as this candle closes with the price inside the Bollinger Band, I enter a sell trade. After placing my sell trade, I need to place my stop loss and my take profit. And I am going to measure the distance between the spike, the highest recent level in the case of a short, and the lowest level in the case of a long. So highest recent level, 40 pip distance from my entry. And because I am trading a volatile instrument, I will need to add at least 25, 30 pips on top of the movement. So 40 plus 25 equals around 65. I will round it up to 70 and give it some slack. Okay, so my stop loss should be somewhere around here. No, even more. Come on. Yeah, around 70 pips. Okay, so I will target a 1-to-1. And as you can see, my target in this case is being hit absolutely no problem. Now, let's look for the next setup. And the next setup is right here. I see that the price has been pushed into the oversold area right here with this candle. Okay, so this candle pushed the price outside, and now I know that I have a trade. I just need to wait for the price to be pushed back. The problem is that the next candle that is pushing the price back is bigger than most of the candles that have constructed the move. And this is another rule that we need to establish. If the candle that pushes the price back is bigger than most of the candles that consist in the move, we don't usually take the trade. So this is not a qualified signal. I would not advise you to take this trade, okay? So this trade right here doesn't really qualify. But just for the sake of the example, I am going to take this trade because I want you guys to see what happens when you do that. I don't want you to take this kind of trade. If you see that the market has been slowly building and moving outside, and all of a sudden the movement gets a correction with a big candle like this one. Now this is not that big. There will be bigger candles than this one. But if I'm comparing it to the previous candles, it is almost twice or triple the size of them. So yes, in this case, this is a big candle, and I will not take this signal, period. I will not enter on this trade normally, but I will give you as an example the execution of this trade. So the market moves back and I will be entering on the very next candle, which is this one right here. And my entry point is going to be this one Okay, so market moved back, candle closed, next candle opens, I enter with a buy order, market execution buy order. Okay, and after I have entered, I need to measure the recent moves. Okay, so the recent move was around 42 pips. To that 42 pips, I need to add at least 25. So 42 plus 25, we are looking at around uh, 67. Let's round it up to 70 again. So it will be around here. Okay, somewhere around here, I guess. Okay, even a bit higher, just like this. All right, so my entry point was here. Okay, this candle closed, I've entered on the next one. What the market will do, will go into negative, almost hit my stop loss, and then it's going to move into positive. Then it's going to move into negative again. Then it's going to move into positive. Now, the reason why I took this trade is because I want to show you another thing. As soon as my trade moves into profit, 30% of my target, or you can do that in pips, 25 to 30 pips, because sometimes you're going to have take profit targets of 150 pips, okay? And you don't want to just leave that without the protection. As soon as you are around 30 pips with the gold, I would go with 30 because it moves a lot and very fast. You move your stop loss to the break-even level. You don't just leave it like that. You need to understand that a stop loss is a stop loss, a break-even it's a break-even. A break-even it's better than a stop loss. But I am going to explain you more after I finish this example. So, all right, I have the trade here. I have entered. I wouldn't have had to enter because this is a big candle, but I did enter. I did a mistake and I've entered. And the market went negative and then it went a bit positive. Normally, on live trading, if I see this position moving from such a loss moving back into profit, I personally would kill it, would close it discretionary without waiting for my take profit to be hit. But this is another story and a different take. This is my execution plan. It can be different from yours. So to have clean rules, it's very simple. I don't close anything. I just hold and wait. Okay. So what I do is when I see that the market has moved into profit over 30 pips, I don't wait anymore and I take my stop loss and I put it on break even. What that means is I move my stop loss to 1 pip positive. In your case, it might be more. I don't know what the spreads are on your broker, but I use 1 pip because on IC markets I pay zero point 0.7 of a lot as a commission. So 1 pip over my entry will give me the break even exit. So in this case, I am being hit back and my position is being taken out and it is on break even. I am not making any profit on this one, but I am also not losing. Okay. So this buy signal, although it doesn't qualify because of the big candle, if you take it, which it's kind of forced, would have been saved by the rule of the break even that says that you should always place your move your stop loss to a small positive position as soon as the market moves into your favor a certain amount of pips. All right, now let's look for the next signal, which it is right here. So this is the first candle that pushes the price into the overbought area. So this candle right here is telling me that I need to wait for the signal which does not come on the next candle because this one goes outside and still closes outside. The candle that closes inside that is giving me the trade signal is this candle right here. Okay, so it closed inside and my entry will be on the opening on the next candle, which is around here. Okay, so this is my entry. What I'm doing after I'm entering, I'm measuring the move, which is around 33 pips. 33, I'm going to give it another 40, so it's 65 for my stop loss. Okay, so that should be my stop loss, just a bit higher, somewhere around there. Okay, and I am going to target the same. So 65 pips target is being hit around here. Very fast, very clean execution on this trade. All right, so let's move on into the next signal. Now, if we look here, let me delete the other lines. If we are looking here, okay, this candle right here is telling me that the price is moving into the overbought, but this is the closing of the day. This is not a time that I would trade. I will focus on London session and on the New York session. So be very careful with the signals to be in the right schedule. All right, what happens here? I have the signal that is telling me that the MACD is on the oversold area of the RSI. The problem is that the price on the Bollinger Bands did not left the Bollinger Band. So what happens in reality here is that as soon as I see this, I stick around and I look at the charts and I wait for the price to go out, but it never does. So this is not a signal. Let me remove this very quick. All right. Here, for example, the same case is the very same thing. As soon as the price goes into the oversold, it also goes inside the Bollinger Band, so that is not a qualified signal. All right, let's see this one. It's this one. This candle right here. It's actually in the overbought area of the RSI. So the MACD, it's on the overbought area of the RSI. The candle is closing outside the Bollinger Band, and I'm waiting for the very next candle to take the price in. This is not that large of a candle, so the signal does qualify. And I will enter my trade on the next candle opening, which is right here. This one goes straight into negative, then positive. Let's measure and see what we have here. We have around 50 pips. Okay, 50 pips, we give it another 30 pips. We go to 80, around 80 pips. This is something like this. 75, yeah, somewhere around there. Okay, so 75, 80 pips, 25, 30 pips plus the movement that you have. So 50 pips plus 25 or 30 pips, that will give you the stop loss, which in this case is 70, around 75. It can be 80. That's how we establish the stop loss, and we go on a one-to-one ratio, which in this case also produces a win. Okay, so we have another win and a break even. Let's see. Here we don't have a signal because the price stays inside. Let's look at this one. This one is a signal, guys. Alrighty. Not that one. This one is above. Also, RSI. It is on the RSI overbought. So the MACD, it's on the RSI overbought area. Also, the candle has closed outside the Bollinger Bands. We are waiting on a candle that will close inside the Bollinger Band. The candle, in accordance to the candles that have built the move, is not that big, although it is a 60 pip candle. Okay, so this candle has moved 60 pips. We are going to measure the spike. Okay, until our entry point. So our entry point will be here, and we have a move of 90 pips, exactly what I was telling you. Sometimes we go above 100 pips. So 90 pips plus 30, we are looking at 110, 120 pips. Okay, when the stop loss is that high, you can play around with it a little bit. It's just how you see the market. If the market is very active, like it would be here, I would definitely give it some breathing space. So I would go with 120 stop loss, which is a fair amount of breathing space for the gold. Now, this was my entry, my short entry. Okay, this is where I sold the instrument, and I am targeting around 120 pips, which is actually filled here. Even if it wouldn't have been filled, it, I would still be moving into the break-even position and hold it until it hits. And yeah, it would not go into the break-even. It will actually fulfill next day if it wouldn't have hit here. If I would have gone with the larger stop loss, which larger take profit, which I would not recommend you guys to. Okay, so this one it's also profitable trade. Yeah, so this is it, guys. This is the strategy. As you can see, it works fairly well. I will take another example, and that will be it. If you need me to make another video on this strategy, just comment in the comment section below, and I will make another video. And also, if you want me to make a video about the swing trading strategy, uh, of, of the trading setup for this strategy, also let me know in the comments section below, and I will make that. All right, so looking for the signal right here, the market has moved into the oversold, sorry, on this candle has moved into the oversold area. All right, the price went outside and came back in on the very next candle, and our entry, guys, is this one right here. This is the perfect entry. It's not going to happen very often, like you've seen from the examples. All right, so this is around 34 pips plus my 30. We're looking at around 65 pips stop loss, which is just about here. Come on. All right. Yeah, anyway, around 60 pips, and my 60 pips take profit is being hit right away with this big candle. Okay, so just to recap the full setup of the strategy. RSI, I only need the levels for the overbought and the oversold area. The MACD, we don't need the signal. We leave the parameters as they are. We only need the histogram that it's painting, and we use it as our signal trigger. And the Bollinger Bands that don't have any special setup, I only change the color and the thickness of the bands. The way that the signals work, once again, the MACD has to be in the oversold or the overbought area of the RSI. We need to wait for the price to be also outside the Bollinger Bands. Once the price is outside the Bollinger Bands and it closes inside the Bollinger Bands, that is our entry trigger. We measure how many pips the market has moved in the sell positions, how many pips the market has previously moved down, and in the has moved up, sorry, and in the buy position, we measure how many pips the market has moved down before we establish our stop loss, and we also add at least 25, 30 pips to that position to make sure that we leave enough breathing space for the price to move. Okay, so RSI, overbought, oversold, price has to be in the overbought or on the oversold, also has to be outside the Bollinger Bands, needs to go back into the Bollinger Bands, and then we enter only if the candle that is putting the price back into the Bollinger Bands, it's not a huge exaggerated candle. Okay, this is another good example. Look here, this is a very small candle that goes outside. This is a very small candle that pushes the price back. This here is our entry. We have here 20 pips plus 30. It will be our stop loss will be around here. and it is around 50, 55 pips, and our profit target is being hit around here, okay? Because that's the move. No, this trade would probably go into break even because here you have 30 pips plus, and you also need to move the stop loss to break even if you adopt this rule, and I would recommend you to adopt the rule of the break even. So as soon as the market moves at least 30 pips in your favor, just move the stop loss to break even. Okay, so this is the strategy. This is the setup. I hope that the way it works, I hope that it is clear to you the way it works, and I haven't made it too complicated for you to understand. And yeah, if you need anything more, just ask me on the comments section, and I will try to answer to you. And yeah, this is it. Remember, guys, that this strategy has been used for decades. It's still working and it's still being used. There are derivatives of these strategies, but the main and the core strategy behind it is the one that I have shown you. Don't use it for day trading other than the 15 minutes, and you should be fine. And also use it on instruments that are volatile. It works on slower instruments also, but not that good. I tested on demo, see how it goes for you, and if you like it, use them on lower. But on very slow instruments, it would not work. All right. Thank you very much for watching, guys. I will make more videos with interesting strategies like this one. If you want to be notified, don't forget to subscribe to the channel. If you like this strategy, don't forget to share it with other guys, and also like the video. Thank you very much for watching. Good luck trading, everyone, and stay green. I'll see you all on the next video. Bye bye.